We are live, and we are the walking wounded here at Wall Street View. We have Kevin, who's a little under the weather. Berna and I are both very under the weather, but we're here for you. We're here for you, Wall Street Beats folks, subscribers, and not. Today we have Berna Borche talking about, appropriately, for the Lunar New Year, a Chinese stock that she owns, and she's going to talk about, and Kevin Baker, a whole bunch of things. And I'm going to talk about Teva and the biotech index, but why don't we kick it off with Berna? Berna, what do you have for us? And Happy Lunar New Year.
Happy Lunar New Year. My ability to go out and party tonight has been impaired by this book, but wishing everyone a good New Year. I was just saying in the pre-show, it's funny that I'm going to talk about a Chinese stock for the second time this year because I hadn't bought a Chinese stock until recently, like since 2014 when Alibaba went public. I'm very skeptical of Chinese stocks, but I'm going to get to what makes me comfortable with this one. But the stock is PC Dash, which is ticker 1405 on the Hong Kong Exchange. There is an unsponsored ADRs, but it really just trades by appointment. So the liquidity is in Hong Kong. But as intimidating as that may sound, you can easily buy these shares on platforms like Fidelity or Interactive Brokers. Its listing shouldn't be an impediment to a good idea. So this is Domino's Pizza in China. It's a concept that has worked around the world. Everyone knows what Domino's Pizza is. Cheap pizza, fast pizza. They've got listings, obviously, in the US, also in the UK, Australia, and now China. I think it went public in 20. So they just hit 1,000 stores. I think the question would be, pizza isn't exactly an indigenous food to China. Will it be embraced? Pizza Hut, which is part of Yum China, was already big there, although Pizza Hut in China is a little bit different than Pizza Hut in the US. It's more of a sit-down restaurant. They do serve pizza, but they also serve steak and chicken and all sorts of other things. But 1,000 stores, 19% store level EBITDA margins, very healthy, on par with what in the US. Proof of concept is there. They do localize the menu. Their most popular item is a durian pizza, not something that you're going to find at your local Domino's here, but they've managed to make it work for the local market. The interesting thing here is there are only 1,000 stores. If you look at Pizza Hut, there are 3,600 Pizza Huts in China. There's probably close to 10,000 KFCs, which on a price point basis is closer to Domino's. A Domino's pizza costs about $4 in China, assuming two people are splitting it, $2 each. Much more, the check is a fraction of what you would spend at Pizza Hut. If there can be 3,600 Pizza Huts and they're still opening 400 stores a year, you would think that you could definitely, for at least 4x the number of Domino's Chinas versus where they are now. So there's two ways to win with this stock. You have 1,000 stores that could go to 4,000 or more, which is a lot of compounded growth over a long time. And also, critically, this company has not started delivery. It's all pickup right now. Right now, they're capacity constrained and they're getting their systems together. These are all company-owned stores. But once they're relatively new stores. Once they're ready to turn on the delivery spigot, I think you see strong positive comps from that as well, too. So you've all this baked in growth of just a unit opening story, which is on a concept that's proven to work. And it's only 14 times next year's EBITDA. It's still a relatively small company. It's about 10 billion Hong Kong market cap. On a USD basis, that's 1.3 billion market cap. So 14 times EBITDA, about 2 times sales. It's just a good growth compounder, not complicated. I think the only thing complicated here is China. And you always have to wonder, do you trust the accounting around a Chinese company? There are two things that are giving me comfort here. One is that Domino's US owns 14% of it, so there's a close relationship there. The other thing, which is something I learned at the ICR conference, I knew that Zohar Ziv, who is the former CFO and COO of Deckers, he was at Deckers from 2006 to 2015. Deckers is the parent of Uggs. So while there, he oversaw that giant expansion in the Uggs boots and also was one of the key people responsible for buying Hoka, which was an unbelievable acquisition for that company. Obviously, an amazing sneaker brand that's had incredible growth. So he's a fine executive and he is a co-founder of this business in China. And when I spoke with him at ICR, it was clear that he is very actively involved in the business, is in China at least 4 times a year, and he's on the board, but he's also very hands-on with knowing what's going on. And to me personally, I'm always nervous about Chinese companies. I had previously spoken about Miniso on the show, and I own that briefly, but I chickened myself out of it because I'm just not comfortable with the local management, and there's too many short reports and stuff out on it. It did okay. It went up about 20%, and I was just like, done. I couldn't buy and hold it. But like this one is a total buy and hold compounder. I could see owning this for years and seeing it going up 15 to 20% a year with their store growth for many years to come. And I do feel comfortable with the idea of buy and hold because there's, a co-founder and board member who Decker's probably was about 7X during the time he was one of the chief C-suite executives. And this is a guy I trust. He has a lot of money. He has no reason. He has a lot to lose in being involved in something that doesn't work out. He would only be there. He believed in it. Gave me a lot of confidence in being able to buy this as a buy and hold kind of compounder, classic compounder growth at a reasonable position.
So how has that business, like same store sales, is that sort of what they report? Do they report the same metrics that a lot of U.S. companies report?
Same store sales, restaurant level EBITDA margins, operating margins. It's same metrics.
And are there other examples in China where they've gone from a company-owned store thing to a franchise type model, or is that just not something that's done? Okay,
oh, yeah, totally. These guys are company-owned now. Maybe they'll move to franchise later, but Yum China has a mix of franchise and company-owned stores for Pizza Hut and KFC China.
So is that one way that all of a sudden, if they were to announce that, is that viewed as a huge positive because that accelerates growth, or is that no, that's changing the business model? That's a tougher business to manage.
It can go either way. It can go either way. Usually franchise businesses get a higher multiple in the market because there's less capital intensity, less need to invest, and you can grow, faster on an asset light model. So theoretically, a move to franchising would take the multiple up. But of course, in this situation, it introduces business risk. So I don't think there's any plans in the short term to go to franchising. But, as they move beyond tier 1 and tier 2 cities, maybe with tier 3 cities, they might. You have to remember a tier 3 city in China is like 1 million people. So,
yeah. All right. But that's a really interesting one. I'm going to take a look at that because I agree with the risks of Chinese companies and the rest, but there are a couple things that do mitigate that risk a bit, especially with a name brand company like this. They're not going to reputationally risk it with completely fraudulent financials. That's a great one. Kevin, what do you see in this chart, or do you see anything in particular that we should worry about with how this stock has been?
Yeah, it's an IPO, so there's very little price history. This is a cup and handle, the way that William O'Neill, may he rest in peace, would define it. Cup, handle, it's exactly what you want. This is a base being built, in my opinion. This yellow line is 79.30, which is where we're trading right now. I can't really see much here on the volume front. That it's so tiny, I can't really get a perspective. This is obviously a Hong Kong listed stock. I don't have it in my system, but this is the key level here, which is not that big of a deal. This is 85, so it's 7-8% above. And once you see it close above 85, I think it's Katie bar the door. Everybody makes money, especially if you have above average volume. To me, that's 150% of normal, and you're off to the races. So this looks terrific to me.
The other thing that I forgot to mention here is that there's no U.S. coverage on this. Like, there are no big bulge banks writing on it. The only non-Chinese bank covering it is Jefferies out of their Hong Kong office. So I think that at some point, as it grows, it will attract some coverage out of the U.S., and then that could be a catalyst for value realization.
Who brought the deal?
That's a good question. Let me see.
Logical coverage coming, right?
Yeah, so while you think about that, I will tell you that the Jefferies Chinese group used to be part of CLSA, which is a bank that I worked for. And some of the folks there moved over. Actually, most of the folks moved over. And they are a high quality group. Like, that's, if I were looking for coverage and I had a Chinese company, I would definitely be like the Chinese Jefferies group is a great group, having worked with them.
It looks like Merrill Asia did the IPO and B of A did some follow-ons.
Okay.
All right. Kevin, what else? Let's move on. Kevin, what else do you have for us?
I have NVIDIA, which, I mean, I can't tell you how many trees have been killed and phone lines have been burned in order to discuss NVIDIA and DeepSeek this week. And I keep things very simple. This is the daily of NVIDIA. And for the poor members and prospective members that listen to me all the time, this is my sell discipline. And I listen to Alex Kantrowitz, and I'm listening to all these people. But the bottom line is, this is the first close below the 200-day moving average in a long time, 2 years plus, frankly, on big volume. We did when I first came on board here, I did a show called NVIDIA Isn't Cisco. And for members, I'll put this in our live chat, the Cisco comparisons. But this is a negative. You can't take the DeepSeek threat and say it's neutral. It's a negative. How much of a negative remains to be seen, and I pity the poor people that have to model this. But the bottom line for me is I would sell a third of NVIDIA, and I would give about that much thought to. And this is because I've studied all these stocks that roll over from Cisco in 2000 to NVIDIA right now. And I'm not saying this is going to roll over, which is why I say a third, because sometimes they just take it on the chin, shake it off, and go off to new highs, especially with the dynamics that NVIDIA has. But this is problematic. This has spent 2 years above the 200-day moving average, and now it's breaking down below it.
Doesn't it go to the real point of DeepSeek wasn't part of the conversation up until a week ago. All of a sudden, this becomes part of the conversation. The stock tanks, and now in morning meetings and afternoon meetings, for that matter, because of the decline, that portfolio managers are asking their analysts, "Hey, what's the story with this?" And the only thing that can be discussed is that it's a risk and how much of a risk it is. It can't be dismissed. It can't be thrown away so if you've made a lot of money on it, and presumably anybody who's been in it for a year or so has made a lot of money on it, they're saying, okay, I don't need to own as much, right? Is it as basic as that?
That would certainly be my stance, because, and I've seen this movie. When stocks roll over, this is how they start. They don't all roll over, but all the ones that do roll over and decline significantly, and I'll show you Cisco to members, this is what they start looking like. Then you have the bounce. Then you have the apologists come up and the bulls say, it isn't that bad. You pull on an expert from China and or elsewhere, and you say, hey, it's going to be okay. And you give all the reasons why people aren't going to use Chinese models and all these kinds of things. The more I hear, the more negative I become on NVIDIA. I am far from an expert, but to me, this is a shot across the bow. And like you say, what is it, 7% of the S&P? I'm making this number up. I sure wouldn't be overweight now. And every active manager that suffered through this for the past 2 years is quietly applauding, saying, see, I told you it was overvalued. Get me out of the way. Let me find some other names that go up while this goes down. Maybe I can pick up a couple hundred basis points and live to fight another day if my 2025 number looks good. But for me, this is a sell a third and then we'll reassess.
That's right. It's in a way, it's a lot like Lilly or Novo in just with a different product. You have a great product. You have a great company, super innovative, and you have a blip of bad news and you see this giant reaction, and that kind of tells you something about valuation. And then who's going to jump in to buy it? It's tough, because if you didn't own it, you were probably saying it was overvalued. And now you're like, okay, 15% lower. Is that the reason? But it's an interesting one because it is on everybody's radar. You can't not keep an eye on it because it affects the whole market. But
hey, Jen, can you go to the weekly? Do you have the weekly up, or I'll put it up on mine? It's the next chart. I can pull it up if you can. Yeah, that's the daily. The weekly, it's the one underneath it. Okay, never mind. I'll do it because I just like to put these things in perspective. So here's the weekly. Here's the sell yesterday. But just look at this. This is a triple for 2 years, and it's spent
and if
2
you own
years.
it, and if you own it, the day that it's down 15% or whatever it was down, you feel it like, oh my gosh, I've lost a year or whatever. But if you step back, and then when people tell you to step back and take a look, it still doesn't feel that great. But I know what you mean, that when things roll over, you don't know when it's the start of rolling over or when it's not, but taking a little bit off the table when you've doubled your money in a year or two isn't a bad idea.
And tripled in 2 years, more than tripled in 2 years. That doesn't happen too often. It just doesn't. And I always look at this from the perspective of active management. How do I get back in the game? People are bashing me left and right. I can't beat the S&P. How do I beat the S&P? And you have to make some calls where I'm going to dramatically underweight NVIDIA and perhaps the rest of the AI trade and move on to some other things. I'll compare it to Cisco. I'll do that in the live chat, show those charts. But to me, it's clear as day. NVIDIA is at sell of at least a third. Stay tuned, and I'll let you know when the other parts of the sell discipline kick in.
All right. What else do you have for us, or is that it for now?
That's it. I want to put the Cisco chart up. I'll do that in the member chat. All
right. So I have a few things, and I know you have something to help me with. I first want to talk about Teva. And like I said, we're all here fighting colds, or at least Berna and I are. I'm probably not even responsible for what I'm going to say on this. And it's actually, there's a lesson in that, right? If you're under the weather and you haven't had a chance to listen to the call, Teva had their conference call this morning. I haven't had a chance to listen to it, but I did read the press release. They gave guidance was fine, but the numbers came in just in line on the EPS, below on revenue guidance. So it's and the stock's off 10%. So and what I meant by starting that by saying, look, there's a lesson in that. If you're not feeling well and you think you're a trader, don't trade when you know you're not on top of things. Like, okay, so I see that it's down a bit, and I could make the argument, and I will make the argument, that it's under 10 times guidance, which was my target, right? I had said, I think it's a $25 stock. It should be $250 for earnings this year. And that's exactly what they gave in guidance. And 10 times, I think, is a reasonable number. The market doesn't think that today. So do you buy it on a dip because of this? What are you off? 20%, 25, 30% from a target price for this year? That's a great return. But with a margin of error, you probably I want something more than that. Different people will have different things of buying on dips. Are you a trader or are you not? I did buy a little bit, down 11%. I do think that it will get back to 25. But I could see where what's changed here is that I owned it for earnings beat and raise and paying down debt. You had not a beat and raise this quarter. So I definitely am having thesis creep, which is a bad thing. So I'm aware of that I still think that they're just lowering the bar so they can beat and raise through this year. It's the pattern, but it might not be. And I could see where a lot of other people who are up 60%, 70% on the stock go, you know what, I'm done. Or like Kevin said earlier, you've had a good return in a year. Why not just take a third off? Under 20, I think it's a pretty good buy for me. But I'm also have a itchy trigger finger on this because it could be rolling over. I think there's some really good catalysts at the end of the year. I think they'll get approval of a long-acting antipsychotic, which could be a multi-billion-dollar product. And so when we get to the second half of the year, people will start to get excited about that. They're just not excited about it now. So you have two kind of owners. You have value owners who are buying the beat and raise, and you have the catalyst-driven folks the hedge funds that aren't going to step in today for catalysts later in the year. But that's a Teva. But Kevin, what do you see on the Teva chart?
Gap down, trading at the low on big volume. Don't like that. But this is the most emotional hour. So the earnings release came out pre-open.
Yep.
And the call was pre-open. So you have all this pent-up emotion and aggression. That's when you tend to have the flush. Let's see how it closes at the end of the day. If stocks close in the top third of the trading day, I tend to say, all right, I'm going to discount that swoon that we saw in the first emotional hour of trading. Having said that, remind me, it also is staying above the 200-day moving average. So that's why I like to use these smoothing mechanisms so I'm not trading all the time and getting whipsawed. Remind me again, December 17th, there was a positive catalyst that caused the gap up to here. I think it was an approval or data or both. And remind me why if that's being negated by this news today.
Yeah, so they had data on a drug for, I think it was Crohn's disease, but I think it was Crohn's disease, a GI drug. And that gapped higher and it stayed there. Now, what we are seeing, and I just pulled up the minute by minute chart here, seems to be an acceleration. Maybe someone downgraded intraday, but it started to come back. I got filled at my down 11%. Now it's down 14%. Thus the dangers of trying to figure out sentiment versus valuation. And you can always wait. Don't trade when you're sick is the lesson here. But also, I wanted to talk about another name, and I'm going to share a screen here, see if I can do this without showing everything. I want to talk about another name. I really didn't want to share this on the live because I just see it, and
Darth Vader. What's the symbol, David?
Like Darth Vader, or am I better now?
There you go.
Okay, Z-Lab. So this is a company that's a biotech company that's based in China. So another Chinese Lunar New Year play. But they're based in the US and China, really, because their business model is unique, that they take US biotech drugs, they license them in, and then they're the marketing arm in China, but they also have their own R&D capability. And they had data last night, actually, that from a phase 1-2 product. And so to me, it's a risk mitigated biotech that it has their own research and an in-license model. They're all already commercially profitable in China, and they have multiple catalysts ahead. I mentioned that they have a pipeline of drugs from the US, one of which is schizophrenia drug that Bristol Myers paid. They bought a company, I want to say it was $7 billion. I think that might be right. They bought the whole company just for that drug in the US. Z-Labs has that drug in rights in China. That's the CAR-XT. Should be approved by the end of this year. Might even be early. It's the first new drug in schizophrenia in like more than a decade. They have other drugs. I mentioned that they had a phase 2B trial that came out positive yesterday, probably why the stock is up a little bit. All of biotech is up, but they keep getting good data points. That drug's for non-small cell lung cancer, so big product opportunity, but it's still early. So this is just phase 2. Vyegart is a product that was launched in the US already. In China, it's been the top immunology launch ever in China. That's how they got into commercial profitability. And when I say commercial profitability, what I mean by that is that if you don't include their R&D, they're commercially profitable. It doesn't mean that they're a profitable company. They're not. And they're probably going to lose money for the next 2 years because of the R&D side of things. But here's their pipeline. I only show this because I'm not going to go through the whole thing to say, look, they have a lot of assets. Some are approved in the US already, some aren't. You see where they say the commercial territories that they own Greater China, those are mostly the ones that they've in-licensed. When they say global, that means they're developing it. And if they're developing it, that means they could out-license those. And that could be another range of catalysts for this coming year. I'm not going to go through all of this because we don't have a lot of time. And entering clinical phase this year, they have 3 different drugs entering the clinical phase. That means they're going into humans. And that means data should be coming out a year or 2 from now. But as you get more clinical assets, you're building value, presumably, because you're spending the money to get it closer to market. Cash profitability, they're hoping by the end of this year. I'm not that worried about that because I can see it on the horizon. And so overall, it's like owning biotech, but there was a company a long time ago that you would use the phrase little r, big D. In other words, lower risk on the research side of things, but more focus on the development side. So they're not taking the risk to invent these drugs. They're letting the US companies do that by and large. For their own pipeline, of course, they have that. So that Z-Lab, I really like it. I don't want to say, oh, it's my number one biotech pick for 2025 because I have a bunch of them. And I don't think that any investor should, or at least I don't bet on any one company. But I like that mix of risk and not risk. Kevin, tell me that the chart looks good because I need it to be confirmed on all points to be able to go nurse my cold and not worry more.
No, I like this. Again, I want to see the up volume exceed the down volume. So in this case, it's the blue lines down here. And so the volume picks up on the up days. This to me looks like a very reasonable consolidation. The moving averages are moving up, which I like to see. This base is now 4 or 5 months old. And I like this. This is to me, a pretty significant change in trend that occurred after 3-year decline. And now this suggests something is happening here. I want to see it above this 36 level or so. And then you really got something going, especially if the volume picks up. And I like the taking drugs and applying them to other countries. And then you have the occasional pop of positive news with anything you're doing on the R&D side. I'm a fan. And you know me, I tell you I wasn't.
Yeah, I know you would. No, again, I recommended it, or I said that I bought it in the middle of last year on Wall Street Beats, and I wanted to revisit it because I don't want people to think that he hasn't mentioned it, that means he's out of it or anything like that. I still like it. I still like the model. But I think that's enough for us for today, unless anyone has anything else. I don't think so. The walking wounded today, but we will be healthier the next time, I promise. And if we're not, it was nice knowing you. I'll see you all the next time on Wall Street Beats. This is David Maris with Berna and Kevin. Thanks.
See you, folks. Thanks.